enter a trade because a trend line breaks. The price suddenly reverses, shattering your stop loss, and then instantly rockets back into profit. This happens because most traders define risk subjectively. They set stop losses based on how much financial pain their account can handle, picking an arbitrary line on a chart and hoping the market respects it. Elliott Wave theory provides a structural map designed to identify where these guesses fail. It tracks price movement through a series of requirements that only allow for two outcomes. The count is either valid, or the pattern is invalidated at a specific price level. This diagram shows the underlying DNA of market cycles. In high-liquidity assets, price pushes forward in a 5-wave motive sequence. That's your trend. It's then followed by a 3-wave corrective sequence, representing market hesitation. To move toward objective execution, a trader filters every price movement through this strict 5-3 sequence to determine where the trend actually sits. Before you risk a single dollar, the market structure has to clear 3 mathematical gates. If any of these rules are broken, the count is discarded. This chart demonstrates the first law. Notice how the second wave drops entirely below the starting point of the first wave. Because wave 2 can never retrace more than 100% of wave 1, the bull thesis is now dead. Now the chart resets to a valid wave 2, but look at wave 3. It's visibly shorter than both waves 1 and 5. This triggers another error, because wave 3 can never be the shortest of the 3 motive waves. Finally, the structure adjusts to a valid wave 3, but the fourth wave dips down and intersects the peak of wave 1. In a standard impulse, this overlap is forbidden, meaning the trend is not what it seems. To navigate the frustration of a valid fourth wave, use the guideline of alternation. If wave 2 was a sharp, aggressive drop, you can generally expect wave 4 to be a complex, sideways consolidation. These rules identify the exact price points where a market structure is no longer valid. When price hits these levels, the logic behind the trade has vanished, giving you a non-emotional location for a stop loss. Wave 3 is often the longest phase of the cycle. It represents the point where the majority of the market finally agrees on direction, leading to the most explosive price action. This diagram shows the use of Fibonacci convergence. By measuring the length of wave 1 and projecting it from the bottom of wave 2, we can identify a specific price target at the 1.618 extension. During highly volatile Forex news events, market momentum often cuts straight through that initial level. In these cases, the 2.618 extension becomes the next area to watch for the impulse to exhaust itself. To find an entry, you drop down to a 15-minute chart. You aren't looking for the massive wave 3 yet. You're hunting for a smaller subwave inside it, known as the wave 2 of 3. You buy the break of the subwave 1 peak. Your stop loss goes at the origin of subwave 2. This creates a much tighter risk profile than placing a stop at the major wave 2 bottom. Targeting this phase of the cycle transforms trading into a controlled plan based on where momentum is highest and risk is most clearly defined. Even a micro setup that follows every rule will fail if it fights the overarching macro trend of the market. This image visualizes fractal concurrency. Notice how the detailed small-scale 5-wave sequence fits perfectly inside a single massive wave of the 4-hour background chart. Without this alignment, you risk falling into a B-wave trap. That micro upward impulse you bought might just be a temporary correction inside a much larger, dominant downward trend. The professional execution checklist requires 3 steps. Confirm the 4-hour trend, align the 15-minute subwaves in that same direction, and lock in your exit at the mathematical invalidation point. Take a moment to audit your last 5 setups. Ask yourself if a strict exit point based on these rules would have protected you from your largest recent drawdowns. Standardizing your execution is not about predicting every minor fluctuation on a chart. It requires aligning the direction across multiple timeframes and adhering to the invalidation points defined by the waves. Log into the FXNX trading portal to apply these rules to your charts. You can access zero-pip spreads, ultra-fast execution, and advanced Fibonacci tools on NX charts today.